What are the potential risks to the markets? Nouriel Roubini asked. We have seen, of course, a sharp rally in US equities this year, 2021, and indeed 2020, which has been fueled at least in part by expectations that interest rates will be kept low for a long time, according to the Financial Times. By many standards, markets can be said to be frothy. If you look at Shiller's cyclically adjusted price earnings ratio, a key measure of whether equities are pricey or cheap, it is high. So as at Tuesday, the 21st of December 2021, that ratio was 39. It had gained 0.68, a gain of 1.78. So the maximum, which was recorded in December 1999, is 44.19. The minimum was 4.78. That was in December 1920. The median is 15.86. So yes, indeed, the current Shiller price earnings ratio is high, 39. That's the figure. Just 5.19 points shy from the maximum recorded in December 1999. So according to Nouriel Roubini, private equities are expensive. Real estate, both the home prices and rents are expensive. Government bonds are expensive and the yields are low. Corporate debt is expensive, with high grade bond and high yield bond spreads being very low. High grade bonds are ones that are believed to have a lower risk of default and receive higher ratings by credit agencies. Higher yield bonds, also called junk bonds, are bonds that pay higher interest rates because they have lower credit ratings than investment grade bonds. So, according to the Financial Times, the European Central Bank warned in November of this year, 2021, that there were signs of exuberance in housing and junk bonds as well as cryptocurrencies. So, according to Nouriel Roubini, there has been a crypto bubble, there has been a meme stock bubble, there has been SPAC bubbles or a SPAC bubble, and some of them are somewhat unjustifiable, and driven by low long rates that can go higher. So what are the potential risks to the markets? This is what Nouriel Roubini asked. The risk in the markets are due to several highly risky assets. One, the bubble that is existing in many of these markets could deflate and we may have lower PE ratios. Secondly, Omicron may slow down economic growth and earnings. It may slow down economic growth and earnings and give a hit to the equity markets. There are supply bottlenecks that could worsen, causing lower growth and higher inflation. Inflation could remain high, hurting stocks and other risky assets. Though some experts like Bob Kendall of the Kendall Report, a YouTube channel, think stocks will do well with high inflation because of the fact that these higher prices will be paying. They will ultimately go to these businesses that are mostly listed in the stock market. So if with inflation, their earnings will be higher, so stocks are likely to go up. And there's also a projection that the S&P 500 will reach 5,300, as you saw earlier on there. So 5 central banks, according to Nouriel Roubini, may be seriously hawkish on inflation and raise real rates, hurting markets. Additionally, central banks could instead wimp out and allow inflation to rise, but that would imply that nominal and real bonds will go higher, hurting equities. Moreover, central banks could end up in a dilemma in such a situation. Now, if stagflation emerges, which is slow growth, relatively high employment, and rising inflation, then that dilemma will be: do they fight inflation and hurt growth even more, or do they essentially help growth by easy monetary policy by causing even more inflation. Moreover, central banks could make policy mistakes if there is a fiscal drag in US and Europe that leads to slower growth, whilst they central banks are still hawkish. So fiscal drag is a case where more and more people get into a higher tax band, and the government earns more revenue, but there's a mismatch there. So it's basically, in a nutshell, what fiscal drag is about. A case where more and more people begin to earn more money and more get into a higher tax bracket. Some of the markets are worried about the policy mistakes by central banks becoming too hawkish as opposed to becoming too dovish. Then you could have a fiscal drag both in the US and Europe. So this fiscal drag, obviously, if more and more people are taxed more, it will hurt the economy and all that stuff. Even though the money will go to the government's coffers, but it's not exactly the best situation, because government is not exactly, especially the governments in Europe and US, it's not the ultimate aim is not wouldn't be to earn more revenue. It is to stabilize the economy, and having more people being taxed more in the case of a physical drag is not exactly the best for the economy. So and in the US we have the Build Back Better, which may not pass, and markets have reacted negatively, as was seen on Monday, the 22nd of December 2021. And we all know that on Sunday, the 21st, I believe, I believe that was Sunday 21st, but it was Sunday before that, Monday, we all know that Joe Manchin became doubtful. He wasn't sure if he was going to support that bill anymore. So according to Nouriel Roubini, there's a whole bunch of geopolitical risks that can have a material impact on the market. So you have the impending war between Russia and Ukraine. Then if there's an Israeli attack on Iran, if there's the tension between US and China in the South China Sea over Taiwan, if it becomes more severe, then there's a taper tantrum risk from emerging markets. That is, if the Fed tapers, then that tantrum will also affect emerging markets. If the Fed and other central banks hike faster than otherwise, So, yeah. And then you have Roubini went on to say that in spite of the signaling of more hawkish monetary policy, there could be stronger economic growth, helping both profit margins, earnings growth of the corporate sector, and also the fact that bond yields are still low. The 10-year Treasury yields is roughly 1.45% right now, and if bond yields remain low, that could be positive for equity PE ratios. So according to Nouriel Roubini, things can be better rather than worse, even though there is a long list of things that could go worse. Okay, so thank you very much for watching this video.